Short selling seems like an extremely complex concept to get your head around, but today I'm going to break it down for you and show you that it's not actually that difficult at all. How's it going, guys? Ryan here with another episode of Stock Market Basics, and today we're talking about the concept of short selling, breaking it down for you guys so it's not so complex. But as always, before we get started, please like this video, helps me out so much, and subscribe for more content. And if you've got any comments, questions or queries about the topic we're covering today, please leave them down in the comments section below and I'll get to answering them for you. And with that, let's get straight into the video. So what is short selling? And for me, the best way to explain it to people is it's effectively the opposite of what you'd normally do. So traditionally when you buy a stock, what you're wanting it to do is to increase in value, and then you plan on selling that stock for a higher price. Well, short selling is actually the opposite. What you want is to borrow a share instead of purchasing a share from the broker, and you want it to decrease in value, and basically that's how you're going to make the profit. You're going to be selling it at a lower rate effectively and then potentially getting a profit from that. So to break it down into, I suppose, a more definitive example, effectively what it is you borrow the shares from the broker and then you sell them on the market at a certain value. Then hopefully the value of the shares goes down in value and you buy them back at a cheaper rate. And then effectively what you do is you give those shares back to the broker or the lender, and you take the profit or the difference between the initial buy value and the initial sell value, and that is what your profit is. Effectively what you have are two different outcomes. So to make a profit, what you need to do is sell the shares on the market at a certain price, and then the price needs to then drop of the stock and you buy those stocks back at a certain price. That difference in value is the profit itself. Alternatively, the stock may actually increase in value, and effectively then what happens is you owe the broker or the lender the difference in value in those stocks because you don't own them. And to really illustrate this for you guys, I've put together an example to clearly demonstrate the process. And it's a 4-step process. It's really easy to understand when you visualize it. I like to call this the short selling 4-step process. It's effectively the easiest way to get your head around what short selling is. Now, what you have is 3 parties involved here. You've got the broker, who is generally the lender of the stocks. You've got the investor, so yourself, and you've got the market. As always, the market is the mechanism or the entity for buying and selling stocks. So if we take step 1, the broker lends shares to the investor. So the investor actually does not own the shares in a short selling process. And effectively what happens is the broker lends these shares to the investor with the intention of receiving them back. Now, what the investor does is step 2. He sells those shares on the market. So for instance, if you had 50 shares at $1,000 each, that's $50,000. Effectively, you're selling on the market. Now, if we look at step 3, the investor buys back the shares on the market. So either they're going to be buying back these shares at a lower rate or at a higher rate. What we want to happen is that the shares are bought back at a lower rate, because effectively that means you're buying back the shares at a lower value. Then effectively what happens is you have a difference in value. So for instance, if then what happened was the investor decided to buy back the shares and he bought them back at $45 per share, effectively what you'd be looking at is then a value of $45,000, which is a difference in $5,000. Now the investor would then give back the shares to the broker, but there's that difference in value. He's giving back the exact same amount of shares that the broker lent to him, but there's a $5,000 difference. So effectively what occurs is the investor pockets that $5,000 difference. Now, the alternative situation is that the investor buys back the shares at a higher price. So what is happening then is the investor is giving back the shares, but he's had to fork out an additional however much. Let's say it was $55 a share, so he's forking out an additional 5 grand because now they're worth 55 grand, and he's actually losing money. Now, this is really risky due to the fact that there is capital at risk here that you potentially do not have. The difference between short selling and going long is if you're going long on a stock, you can only lose the money that you've put in. Whereas if you're going short on a stock, it can effectively be an infinite amount of money you lose, and it can really send people into bad situations if they are not adequately prepared. And effectively, due to this risk, if you're a new investor, you want to tend to avoid short selling as a result. If you are short selling, you want to make sure you have a large sum of capital backing you up, because it is an extremely risky thing to do if you're not watching or managing it well. And one of the other things that can actually occur is a margin call. And effectively what a margin call is the broker will call back their loan, or effectively the shares they've loaned you. So you effectively have to immediately sell those shares on the market and give them back to the broker. And that means the price may have gone up significantly, and you're going to have to take that hit, and there's not too much you can do about it, unfortunately, and effectively you're forced to then take the loss in that sort of circumstance. Conversely, there is one main benefit when you're short selling, and that is you can make money when shares are dropping in value. So currently the situation at the moment is it's early 2020 and stocks are dropping in value significantly as there is a global crisis at hand. And as a result, short sellers are making absolutely squillions due to the fact that they can easily bet against the market with confidence. In a bear market is where short sellers really thrive, whereas in a bull market it makes it quite a bit harder for them to short stocks purely due to the lack of opportunity. So the benefit of short selling is you can make money on the way down, and then you can just swap over when it is a bull market, and you can make money on the way up by buying and selling shares for a high value like traditionally. I hope you enjoyed today's episode of Stock Market Basics where we covered short selling. I hope it cleared it up a bit for you guys who don't really understand or didn't really understand what short selling is. It's not actually that difficult to wrap your head around when you can properly visualize it and step it out in the very simple 4-step process that I outlined today. And with that, guys, if you liked the video, please remember to give me a thumbs up. Leave any comments or queries down below if you have them, and keep subscribed for more content. With that, guys, hope you have an awesome day. See you next time.